We do believe we're in a bull market that is broadening out, a very healthy bull market, climbing a wall of worry. There is a lot to worry about. Wars and even turmoil in the U.S. Along political lines recently, and yet we have this wall of worry, the market climbing this wall of worry and broadening out. We think, which is very much important in terms of the market sustaining this bullish momentum. We do think that there's going to be a breakaway for innovation stocks, truly technologically enabled disruptive innovation, we think is going to start outperforming these indices.
Cathie Wood begins with inflation and interest rates, two of the most powerful drivers of markets. She argues that both are resolving to the downside, exactly as ARK Invest expected. While tariffs have had some effect on prices, she notes that businesses, not consumers, are shouldering the majority of the burden. The latest data shows that companies are absorbing around 54% of tariff-related costs, while consumers face the rest.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
It does seem like inflation and interest rates are resolving to the downside as we expected, and that tariffs, they're working their way through, and it does appear that businesses are taking the hit, more than half of the hit. Yes, consumers are seeing higher prices for some goods in particular, but businesses are taking about, the last I saw was 54% of the hit. And we do believe that the PPI this week was important, minus 0.1 for both headline and core. And then the CPI, which also came in line with expectations for the most part, with the exception of shelter being higher than expected. And we know that home prices and rents are starting to fall, and that there's going to be a long tail of falling prices because of the big lags in those indices. The other thing I'd like to focus on is valuation. And valuations have gone up in the innovation space generally. But if you take a look at the last time that happened, pre-COVID, we have to take out the boom bust associated with COVID, because we don't think that will ever happen again, even if there were a pandemic. We believe that governments have learned the hard way not to throw money at it. It only causes problems for years afterwards. So we think that was a special case. And taking that out, if you look at the last time, relative valuations were at this level. And that would have been 2016-17. What we saw in the years following, 17, 18, 19, is relative valuations actually fell over those years, but the revenue growth and margin expansion associated with many companies in the innovation space overwhelmed that valuation compression. And as we have been illustrating over the last few years, as we think about valuation, we make that assumption that the valuation of our portfolios is going to compress towards a market multiple over the next 5 years. We do not depend on valuation to get our compound annual rate of return expectations. In fact, quite the opposite. We assume we're going to be penalized. And I can tell you, given our valuation models, that the compound annual rate of return we expect is is very much in keeping with the minimum 15% hurdle rate of return. In fact, significantly above that. We do believe we're in a bull market that is broadening out, a very healthy bull market, climbing a wall of worry. There is a lot to worry about. Wars and even turmoil in the U.S. Along political lines recently. And yet we have this wall of worry, the market climbing this wall of worry and broadening out, we think, which is very much important in terms of the market sustaining this bullish momentum. We have been talking about this phenomenon, particularly in 23 and 24, as the market was hitting all-time highs, and it was powered by the largest stocks in a very concentrated indices by historical standards. So yes, self-fulfilling prophecy, and this is the battle we've been fighting from an active management point of view for, I'm going to say, 20 years. Really, this started after the tech and telecom bust, and even more so, it accelerated and gained momentum, this move towards benchmark sensitivity or passive after 08 and 09. And so we think the pendulum has swung far enough, but we thought that a few years ago as well. As I mentioned in my introduction, the market broadening out here is really important. And we do think that there's going to be a breakaway for innovation stocks, truly technologically enabled disruptive innovation, we think is going to start outperforming these indices. Why? It is because some of the largest holdings in the broad-based benchmarks are going to be disrupted themselves. Many people have been talking about Apple and its inability to get its footing in the AI space or in the autonomous mobility space. What is the ultimate mobile device? It's an autonomous vehicle. And Apple had been trying to break into that world, and I think for the last 6-7 years. And we've seen one turnover after another in terms of strategy and management teams. So that's a candidate and is a very large part of the index.
Wood emphasizes that these shifts don't mean these companies will collapse overnight. But even modest disappointments at the margin could open the door for smaller, more agile innovators to take share. This brings us to her central thesis. Disruptive innovation stocks are poised to break away and outperform the broader indices. Why? Because the incumbents are vulnerable and because innovation is accelerating. The market may be waking up to this reality as leadership broadens and investors look beyond the same handful of mega-cap stocks.
Google, we think, is one of the best AI companies in the world. It has some of the best talent in the world from DeepMind, an acquisition from the UK. And yet it is in harm's way from this point of view. It has had a lock on the search market. And now there are many more players. Perplexity, of course, is one. Even Bing, with OpenAI and Microsoft, is gaining share. Now, Google is also combating that, but the fact remains it had roughly 95% plus of the search market, and that is changing. And even Amazon. Again, we love Amazon's positioning in the cloud. We think the cloud is extremely important here. Oracle's report put an exclamation point on that. And yet, Oracle could it be a spoiler in this market? We noticed that Amazon's cloud margins went down while its revenue growth did accelerate. That's an open question. And of course, agentic AI calls into question whether or not we're going to, as we are on shopping expeditions, whether we're going to let our personal assistant do the shopping for us, or go back to our old habits and start with Amazon, which historically has been the first place many people did start their shopping expeditions. We don't know. And so the world, the very comfortable world that those companies dominated, is changing. And we think that there are many other companies that are much quicker, more agile. But as Nick Gruss, our Director of Research for Consumer Internet and FinTech would say, distribution, distribution, distribution. So we have a live debate here at ARK. Our Brett Winton, our chief futurist, is somewhat skeptical and thinks that there will be more disintermediation than many analysts out there expect. So bottom line, we do think the market's going to broaden out here as some of the most important and biggest positions in these benchmarks start to disappoint, maybe not in a huge way, but at the margin. So with that, just in terms of why we bought BitMine Immersion in the first place, it was very difficult to gain a toehold in Ether through staked ETFs. We had to resort to the Canadian ETFs because the US, at least so far, does not allow staking in ETFs. And so this was a solution, this DAT, BitMine Immersion, for Ether was a solution to that problem. We think that the Ethereum protocol is where most of the DeFi or decentralized financial revolution is taking place. And Lorenzo, I know that BitMine's original goal was to increase its position to 5% of total ETH outstanding. So where are we now relative to that goal?
At ARK, this belief is reflected in their portfolio moves. For instance, their investment in BitMine Immersion, a company focused on Ethereum staking solutions, was designed as a creative way to gain exposure to Ethereum given U.S. restrictions on staking within ETFs. Ethereum, Wood notes, is at the center of decentralized finance, DeFi innovation. With BitMine targeting up to 5% of ETH outstanding, ARK sees it as a strategic play on the infrastructure underpinning future finance. This example illustrates ARK's broader approach, finding pure play exposure to innovation themes that can't always be accessed through traditional benchmarks.